Hello members and welcome to the macro webinar from Fat Profits. My name is Roger Malik. I'm the host for your webinar today, and joining us as always is our founder and CEO and fund manager, Angus Geddes. Angus, welcome to today's webinar. How are you?
Very well, thanks, Rog. Yeah, always good to be here on the webinar on Thursdays.
Excellent, good to have you on board, and I'm sure members who are joining us live are looking forward to an informative session. There's a lot to talk about today with the Reserve Bank and the Federal Reserve and so on. But before we get started, quick housekeeping. This presentation from Fat Profits is general information only. We don't provide personal advice. If you're looking for that, please see your financial planner. And also, past performance is no indicator of future performance. Now, if you are new to this service, this webinar is a macro webinar where we discuss all the big events shaping our economy and the markets around Australia and the world. If you are looking for stocks in particular, then we have a webinar on Monday where the research team discusses 10 stocks every Monday. So that's the difference. But you can ask questions throughout this webinar if you have anything around the macro. Now, before we start the market update, a quick look at the headline topics for today. We will discuss the Reserve Bank rate surprise. We'll talk about the regional banking jitters in the US earnings season, Federal Reserve rate hike overnight, ECB decision coming up in the next 24 hours, oil, Australian dollar, US dollar, the banking sector in Australia, gold price, which is making a nice move up. Of course, we'll discuss the ASX, S&P500 and core inflation. So there's not a lot to talk about. Let's get started. From last Thursday, when we got together in this webinar till today, we've seen the markets pretty much go sideways. There's been a bit of up and down movement, but nothing substantial, with the exception of FTSE, which has dropped over 1%, and Japanese index Nikkei, which has gone up 2.5%. So those are the exceptions, but pretty much we are going sideways. Well, we are now in May, and the old saying, sell in May and go away, is it going to come true this year? Well, time will tell, but we're off to a little bit of a rocky start. But let's have a quick look at history first. And if you look at this particular chart, you'll notice the 6 months rolling return across the US markets. And if you look at May to October, it's pretty clear that's usually the weaker 6 months in the US markets. And then of course the strongest is in the green. You can see November to April. Now we're just coming off the April period where we've seen pretty strong returns in the US market. But now we're entering a traditional period, May and June in particular in Australia, which are typically weaker. And last year was very similar. We had a pretty bad May and June. This doesn't happen every year, but it is something to keep an eye on. Now, before we look at the US markets, let's start with Australia today. And of course, we know what happened on Tuesday, that the Reserve Bank of Australia, Mr. Lowe, he announced a surprise rate hike of 25 basis points. And now the cash rate has moved up to 3.85%. And one of the key reasons why they stated that was, of course, the inflation forecast targets, which are 4.75% by the end of this year and 3% by mid-2025. That's dependent on, rate rises, and they've basically gone up. So Angus, over to you first. What were your thoughts on the surprise rate hike? Was that really a surprise, or a few economists predicted it. I think Commonwealth Bank predicted it. But what are your thoughts on the surprise, and is it something we can expect a couple more of?
Look, I wasn't really too surprised, Roger. I always thought that the RBA was perhaps a little bit premature in pausing with the cash rate at lower levels, because the inflation rate in Australia is at risk of becoming entrenched. And of course, at 7% in terms of the last quarterly print, it's still quite a bit above the United States and other markets where where the cash rate is a lot higher. So it didn't really surprise me, and so there you go.
So I guess the big question now is, now the rate hike has come back, and people are arguing the fact that what was the point of pausing for 1 month? I mean, 1 month really doesn't do anything for data. If you're going to go, just might as well go hard and get it out of the way, like the US markets are doing. I guess now that we're back on that rate hike trail, can we expect another 1 or 2 rate hikes? Is that the expectation and markets now pricing in? I think the real estate sector is certainly showing that maybe there is, that enthusiasm we saw over the last month has probably come straight back down.
Yeah, I think we're certainly a bit premature in the property market. We saw Sydney real estate certainly move up quite sort of strongly in March and April, and so that's going to take the heat out of that a little bit. But yeah, I think inflation, once it's out of the bag, is it's quite hard to bring it back down, particularly when it spreads out to other facets and other components and sectors within the economy. And of course, once inflation expectations become unanchored, then it just becomes that much more difficult for the Reserve Bank. So look, I think we can expect the RBA to be holding rates up higher for longer until that inflation really is brought back under control.
Yeah, I think that's a good call, Angus. And of course, keeping that into mind as well, our neighbours over in New Zealand as well, their cash rate currently is 5.25%, and inflation is just a bit under 7%. So they're struggling to bring that down, even at a very high level. So just put that in context. Moving on to the ASX now, the ASX 200. Yes, we saw since the Reserve Bank rate hike over the last couple of sessions, yes, we've seen weakness, and even today we're in the red. So we're now just shy of 7,200 points, in fact 7,180 or something. How do you see the setup on the ASX? Yes, the trend looks pretty good, but short term, I mean, what are your thoughts, Angus?
Cautious, very cautious near term, Roger. We're moving into May. It's seasonally a weak month for the markets, and I think that May will prove to be a weak month. And yeah, I'm cautious. I think there's downside risk in the ASX 200, particularly given the hawkish move by the RBA last week. And clearly there's more wood to be chopped on the inflation front. I also think there's downside risk to earnings for the market, given the consumer spending is likely to take another hit from that rate rise. So definitely erring on the side of caution heading into May.
Yeah, exactly. We did talk about this exact point last week in the webinar as well, that from a technical perspective, the ASX looks like it's ready to shed some kilos. And we will talk about the banking sector towards the end of today's webinar. We know a couple of the banks are reporting now, including NAB today. So we'll touch on that a bit later on. Let's move on to the US now. And of course, the big news over the last 24 hours, in fact, less than that, was the Federal Reserve in the US. Mr. Powell came back as expected, unlike the RBA, as expected, raised rate by 25 basis points. So they're now well and truly above 5%, range of 5 to 5.25%. So first thing first, Angus, your thoughts on Mr. Powell's comments? I think that's what really the market was looking for. They were expecting that rate hike anyway. It was more in the commentary whether there is a rate cut expected towards the end of this year. What are their thoughts on the banking jitters? There was a lot of questions thrown at him. What were your thoughts?
Look, I wasn't really too fazed by what Jerome Powell said. I was sort of more or less expecting that. I didn't think he was going to commit to a pause. They are data dependent. There's a lot of moving parts to the US economy as it relates to inflation. The inflation numbers are still elevated. The job has not been finished yet, and why would he give an excuse for the markets to to rally, which is why I think he sort of held back from using the pause word. He did say, look, you know, it's entirely possible that rates have peaked with this hike today. He did say that, but you know, he kept coming back saying, you know, we are data dependent. So until that inflation rate really starts coming down, you know, they're going to have to keep the pressure on. I think the other takeaway is the markets were looking for rate cuts, you know, before the end of the year. You know, the first one is being priced as early as September.
Yeah.
And you know, there are absolutely no references from Jerome Powell about that.
Yeah.
In other words, I don't think they will be cutting if inflation is printing above 4.5% as we move through this year. So yeah, look, all in all, it was quite hawkish. No surprise that the equity market sold off. And clearly, you know, in the absence of a shock, there's probably, you know, an event, a centre left of field event. There's nothing in it for the Fed to take the brakes off.
Correct.
You know, you've got an economy that's still strong, labour market's still pretty strong. You know, Jerome Powell referenced that a number of times. You know, the consumer over there is still spending. Earnings were better than expected for, you know, a number of companies. So I think the Fed are going to stay committed for now.
Yeah.
And of course that could be a headwind for the stock market in May. And you know, just as we spoke about the ASX, you know, I think there's downside risk to the S&P 500, particularly the S&P 500, given how concentrated the rally has been this year. Absolutely. And the narrowing of that breadth. So.
Yeah, so we will look at the S&P 500 chart in just a moment. But you're right, Mr. Powell, he did say, I think even they talked about whether the inflation rate of target of 2% could be revised to 3%, and he said absolutely not. So they're committed to keeping it at 2%. The other interesting thing he talked about was recession. They asked about whether he's expecting a recession. He said a mild recession is probable towards the end of this year. So they've admitted that a couple of times in the last two meetings. Time will tell, of course, but they're anticipating that to take shape. Talking about recession, if you look at the GDP, we all know what the definition of a recession is. And if you're not sure, well, 2 negative quarters of GDP is the definition of a technical recession. Now, if you look at the GDP numbers across the US economy, you will notice that early last year, you see 2 negative GDP quarters. While it was pretty mild, but they were declined by most of the policymakers saying, look, this is not really a true recession. Okay, we moved forward. The GDP went back into positive territory, but you can notice in the last 2 quarters, it has declined in a meaningful way, especially in Q1 this year. It has actually dropped to 1.1%. The expectation was 2%, so there is a slowdown in the economy already. This is Q1. So the expectation from the US economists and the policymakers is Q3, Q4, somewhere around that, you will start to see the negative GDP. So that'll be interesting. But the other thing also here to note is core inflation in the US. And this is a good history lesson, if you like. This is a long-term chart from 1958 till today. And you'll notice that, of course, in the 70s, inflation really shot up. This is core inflation, shot up to as high as 14%. And they had a lot of trouble to bring it down. And while it came down a couple of times, it went back up. So that's the fear for the US Federal Reserve. And they don't want to see that. They want to see this inflation be crushed. And one of the things that they ended up doing, and if you add the Federal Reserve cash rate to this, which is the orange line, you'll notice again in the 70s, they cut rates while they raise rates above the inflation rate every time. Inflation did come down, but the mistake they made in the 70s that they cut rates too quickly while inflation was still high, and then it went straight back up. So then Mr. Volcker, who was the chairman of the Federal Reserve back then, he had to raise rates up to 19%, which is unbelievable, and had to keep them for many years before they could finally see inflation come down to 2 to 3% target range. So at the moment, if you look at the cash rate, even after overnight, it's now between 5 and 5.25. inflation is still higher than that. So I guess the part of the market which is expecting rates to be higher for longer, that's the reason behind that. So Angus, any thoughts on that? I mean, you're certainly aware of all of this. So what are your thoughts on this? They have to keep the rates above this inflation rate for some time.
Yeah, look, I do. I certainly believe that. You know, as we saw in the 70s, you know, they raised rates. They thought they had inflation under control. Then they didn't. Then there was a recession, and they started cutting rates. And then there was another secondary inflationary impulse. And then they had to go even more aggressively later on down the track. That was when Volcker took over from Burns and finished the job. They botched it in the 70s. So, you know, if history's a teacher, then, you know, we can expect the Federal Reserve to try to finish the job. And I think that, you know, in terms of where we're at the moment, it means that they are going to have to keep rates above the inflation rate for longer. For longer, I think, you know, this idea that the markets have that they're going to be cutting rates in September is an absolute pipe dream.
Yeah, absolutely.
Unless something happens, and you know, a major bank were to fail, or an incident or an event, you know, we do know that, you know, the Federal Reserve tends to lack, you know, they can lose their nerve. It was interesting, you know, reading about and writing about Stanley Druckenmiller, who's got a massive short position on the US dollar because he believes that the Federal Reserve are going to not finish the job. In other words, you know, but for now, with the economy tracking the way it is, you know, the unemployment rate's still very low, the employment market very strong, and the economy tracking along. For now, and for the foreseeable future, you know, the Fed seem very determined to hold rates up for longer, and you know, and I think that's certainly the path that we're looking at in the next 2 or 3 months.
Absolutely, and yeah, that's where it really comes down to. Let's move on to the banking jitters. Now we know that the Silicon Valley Bank was the second largest bank to fail since 2008, and post that we've seen a couple of others, including Syndicate Bank and Signature Bank, and now we've seen First Republic, which is the fourth regional bank, and they're quite large banks, by the way. They're not very tiny. They're actually quite a substantial size bank. Become the fourth US regional bank to basically go under. JP Morgan coming and acquiring them for $10.6 billion. Looks like now PacWest is now in a little bit of strife. They've dropped over 50% in the last 24 hours. And there's a couple of others now the market's now looking at. The shorters are coming in, and they're now looking at potential sale. Even they came out and made a statement, and they're 50% down in the last 24 hours. So the regional financial index, we know that it's dropped 50% in the last 12 months, but certainly a big drawdown in the last month or two. How do you see this one, Angus? Because JP Morgan CEO Jamie Dimon came out on Monday earlier this week and said the banking crisis is nearly over. We've got this under control. It's all good, but looks like a couple of other banks now under the scanner.
Yeah, look, I think it's premature to say that it's over as it relates to the regional banks. So the regional banks in the United States are not as regulated as meticulously as the larger banks. And whereas in the GFC, you know, it was all about the banking, a banking crisis on the asset side of the balance sheet. In other words, the quality of the loans that were being written, that was the problem. Today, it's all about interest rate risk and managing the funding side of the balance sheet. And of course, the regionals haven't been doing a particularly good job, which is, you know, why the interest rate spike that we've seen, you know, in the last 12 months has seen investor deposit sucked out and funneled into the risk-free money market, where investors are able to access a much higher rate of return on treasuries.
Yes.
And of course, this is what's caused the squeeze. So there's bound to be other banks that get caught up in this, and it's really the interest rate risk that wasn't managed properly here by some of the smaller banks. I don't think it's going to turn into a huge crisis in the United States, because the bigger banks have been forced to manage their interest rate risk. But sure, we could see more regional failures before this is all over. Yeah,
there's something to keep a very close eye on. Moving on to the S&P 500, now it will come back under 4,100. Look, it's a pretty tight call. The last few months have been going up and down, really not really going anywhere. If you're trying to make money in this market through short-term trading, it's very tough. And I think everyone acknowledges, it's up and down like a yo-yo. So how do you see the S&P 500 set up at the moment, Angus, and what are your expectations?
Look, prima facie, technically, if you look at this chart, it's bullish. And we've got the big resistance level at 4,200 and a series of higher reactionary lows. So every pullback's been mild and less severe than the previous pullback. So the technical construct is bullish, but if we look beneath the surface of this chart, what's been driving it? The breadth of the US market has become quite narrow. Just 7 stocks are responsible, as this graph says, Rog. 83% of the S&P 500 returns. We've got 5 companies that account for 20-25% of the S&P 500 index. Apple alone counts for just under 7.5% of the S&P 500. So the rally has really been on the shoulders of just a handful of stocks. So risk is, if anything, has become more concentrated. So look, I'm still defensive, very cautious, and my sort of scenario really for the S&P 500 in May is for it to take out that uptrend and certainly retest the 3,800 level, potentially this month or in June.
Okay. All right. We'll keep an eye on that on a week-to-week basis. But I guess the message to members and investors out there remains the same as Angus said earlier. Stay cautious, stay defensive, hold on to your cash. I think a couple of members asked earlier, Lyle and David, saying still keep our powder dry. So the answer is yes. Keep the cash levels that you may have already attained, and if you haven't, this might still present some opportunities to raise cash levels. Earnings season, look, it's been quite an interesting earnings season. As you said, the big tech, the big companies, they've reported reasonable numbers, and of course they were very low in terms of their previous estimates. So versus the estimates, they've come out swinging. We've got one more big fish, as you said, Apple, which is coming out tonight. How do you see Apple's earnings coming up, and also just overall thoughts on the earnings season?
Look, I have no idea what the actual number is going to be for Apple, but if you go by some of these big technology companies, some of the results have been really good, like really good. Amazon disappointed. It's more consumer facing than some of the other big technology companies. Apple also is quite consumer facing. So look, there is a question mark. I mean, what the number will be, I don't know, but what I will say is it will be highly influential on what the S&P 500 does in May. It will be a very influential set of earnings, and for the rally to continue, for the 4,200 level to be retested and broken on the upside, Apple's got to come out with a really strong set of numbers, shoot the lights out set of numbers, that triggers a big rally in some of those tech stocks, and certainly Apple, which make up such a big chunk of the index.
Sure.
So the caveat is, on the flip side, a number that disappoints will have everyone worried. But those interest rate hikes that have been put through are finally beginning to impact the consumer and consumer spending, etc. So yeah, the bases are loaded. It'll be very interesting to see what happens tonight.
All right, good call. Okay, and finally, before we move on to a couple of other topics, a key stat to look at is the bear market phases. Now, we know that bear markets traditionally go through 3 phases. The first and second are usually reasonable. You can call them corrections if you like, 11 and 12%. But it's really the third and final phase where most of the selling happens, most of panic really happens, and people really run off to the races. And that's typically an average of 24%. Now, currently in 2023, we are in the 3rd longest bear market in history. So this has still got some legs before we can finally call it a market bottom. And as Angus said previously, he's expecting all that action over the coming months. Moving on now, we'll take some questions in a moment. Moving on to Australian dollar and the US dollar. Now, the AUD, Angus, has jumped on the RBA rate hike, hovering between 66 and 67 cents. How do you see the setup for the AUD? And then we'll talk about the greenback.
Yeah, look, I think technically and fundamentally the Aussie, the outlook for the Aussie is pretty positive. So, we've seen the Australian dollar retest that 65.5 cent support level on a couple of occasions since November last year, and it's held nicely. And we've also seen it pressuring topside downtrend resistance, which is the green line. And, I wouldn't be surprised if the Australian dollar breaks out and has another run back towards 70, 71 cents. What's that view based on fundamentally? A couple of factors. Firstly, the rising interest rate, the narrowing interest rate differential in Australia's favour. So that rate hike that went through last week was positively received by the FX markets in terms of the 1% jump in the Aussie that followed. I think we're going to see more rate tightening from the RBA, if anything, to close that gap with the Fed. Secondly, US economic growth is slowing down. There's still no sign of a recession yet in Australia. So we've got a recession being signalled by the US bond market with that bond market inversion. There's no inversion in Australia's bond market. In other words, fixed income markets in Australia are not pricing a recession that economy will get through. So I think that's also going to be good for the Australian dollar. The third factor, of course, is if we're right on the US dollar and the US dollar does break down and have another leg lower in a secular bear market, and here we can see the dollar index fairly precariously perched at 101. A break below that level would trigger another downward leg in the greenback, and I think that would be positive for precious metals and commodities, and also the commodity denominated currencies such as the Canadian dollar and the Australian dollar. So those are the 3 factors to look out for.
Yeah, absolutely. And talking about the US dollar, well, we can't not talk about gold at the moment, because that's one thing which is shining bright, pardon the pun, but gold is shining. And of course, gold stocks have nearly doubled, some of them, like Northern Star, Evolution Mining, and the others. They've nearly doubled off their recent lows a few months ago and looking very solid. How do you see the gold price in the Australian dollar terms? It's now getting closer to the $3,100 mark.
Yeah, Alec, I'm still pretty positive on Australian spot gold prices, but also, gold US dollar spot gold prices as well. And we've had quite a big breakout above that sort of 2,800 level in the Aussie dollar gold price. and we've seen a nice move up to 3,100, and I think we can see further topside extension, over the coming year. So yeah, still bullish, and we have seen some catch up in the Australian gold index, but I think there's further to go there on the upside, because most of those Australian producers are still well down from their record highs, or the highs of a few years ago. And so there's a fair bit of ground that can be made up there. Valuations are still not stretched. And of course, with that, the Australian dollar gold price hitting 3,100, margins are expanding. Free cash flows are also expanding and accelerating, which is a good tailwind. And as I've said a few times on these webinars, what's happening with the gold sector is kind of reminiscent of what happened with the coal sector a year or so ago. When we saw the breakout in the coal price, and it took a while for the coal stocks to move, and then at some point, investors really started jumping on board, simply because of the huge free cash flows that those coal companies were making. And I think the story is playing out in a similar way with the Aussie gold sector. A lot of investors just don't believe it. But Roger, as all our listeners and our members will know, that we obviously think that gold's in a secular bull market.
Yes, understood completely, Angus. That's great. And look, oil, on the other hand, is going in the opposite direction, and the last couple of sessions have been pretty wild, down 11% in 2 days. Is this a sign of a bit of a precursor to a recession that the markets are now pricing in? Yeah,
look, I think that's right. The oil market definitely does not like what's happening on the tightening front in the US. And this downside that we've seen is perhaps also a precursor to a recession. And we can see that the oil price is range bound between 65 on the support, 84, 85 on the resistance above. It's in this range. It's been quite volatile within this range. Look, a downside break at 65 would probably be the surest sign yet that the global economy is actually in a recession. So we continue to watch the oil price quite closely.
Okay, excellent. And last couple of topics, we'll take some questions afterwards. Is European inflation, you can see the core inflation right there, is still hovering around that 5.5%, 5.6%. They've got a decision coming up tonight with the interest rates currently sitting at 3.5%. The debate is between 25 and 50. How do you see the ECB decision tonight?
Look, I think the ECB are going to run with a 50 basis point rate hike. I'd be surprised if they went with anything smaller. And I think that's going to provide a bit of an impetus for another upside breakout in the euro against the dollar, which will translate into more weakness in the dollar index. That's pretty much my sort of scenario. Clearly, Europe have an inflation problem that's worse than what we're seeing in other countries, and they've still got quite a lot of work to do on the rate tightening front. So yeah, I think there's further to go on that front.
Yeah, absolutely. And then there's Bank of England next week as well, so there's no shortage of announcements. And the last topic today is we thought we'll touch on the banking sector, excuse me, in Australia. We know that NAB has reported earnings today, and a couple of other banks will be reporting as well shortly. Look, how do you compare? Well, let's start with the Australian banking sector. Let's not compare with the US, because that's very different. We know that. But how do you see the financial health of our banking sector, given what's happening with the Reserve Bank rate hikes and the property sector downturn? What are your thoughts on the overall banking sector?
Look, you know, I think Australian banks are amongst the most tightly regulated in the world, and you know, we don't have as many of them as there are in the United States. Sure, the economy's smaller, but you know, it's a cozy market. So I like the banks over the longer term, but look, near term, they've got a lot of headwinds. You know, interest rates are on the rise. Funding costs are going up. It's competitive for deposits. You know, so you're looking at pressures on net interest rate margins for the Australian banks. I think that the residential property market's going to continue to slow, as it's now obvious that the RBA have got more work to do, and they've got to keep up with pressure on rates, and that's going to impact loan demand. So near term, still negative on the banks. I think there's further downside, further consolidation is going to be required before a new up cycle begins. You know, we are underweight Australian banks in our separately managed account portfolios. But, you know, having said that, Roger, you know, medium to longer term, I think the Australian banks are going to be fine. You know, they'll come through this perfectly well. You know, for investors that have held CBA for 10 or 15 years, there's no point going and selling it, paying a whole lot of tax. It probably won't come back enough. But, you know, for fund managers which are sort of measured on a quarter by quarter basis, you know, it will pay to be probably underweight the banks for at least the next 2 or 3 quarters until we get to the end of the rate tightening cycle in Australia, and we're not quite there yet.
Yeah, that's a good point. So I guess the message for long-term investors is to just maintain your hold position, which we have done on our research portfolio. For shorter term, shorter view traders or investors, look, obviously this is a tricky proposition because shorter term, as you said, there might be a bit more consolidation, a bit more correction before they go again, probably in a few months from now. So I'll take some questions now. Thank you for that, Angus. Appreciate all your insights so far. Very good. I'm sure members are enjoying the conversation and getting some insights on this. So we'll take some questions now. So first question is from Kev regarding the Australian banks. So he's saying, are the fortunes of Australian banks tied to their US counterparts and there will be further downside? Alternatively, do the Australian banks now represent good value? I think partly you've answered that, but if you can.
Yeah, look, I think they're looking like they're better value, but I mean, the question is, will there be even more value on offer looking out over the next couple of quarters? So yeah, I wouldn't be rushing in to buy them today. I'm quite happy to run an underweight position against the Australian banks for at least this quarter, and you know, continue to reassess it. And when I get a sense that the RBA are done with their rate tightening cycle, and that the banks are technically look like they're bottoming out, that will be the time to be buying and adding to positions. So sitting on the sidelines for now as it relates to the banks.
All right, great. And next question is from Jeffrey saying, hi Angus, why do Australian analysts think RBA should not increase cash rate, but then expect the US Federal Reserve to raise? Seems to be directly contradictory expectation. It appears that politics has intervened in the analyst's rationale. Please comment.
Yeah, look, I thought the whole sort of attitude was misplaced. That that the RBA had finished hiking and the pause was going to run for for some time. I never really believed it because the inflation rate was so high, and the gap between the cash rate and the inflation rate probably too wide. The cash rate hasn't been high enough to do the job and bring inflation down. And as we heard from Governor Lowe this week, they're dead set in terms of their mission to bring inflation down, which is why they raise rates by 25 basis points. And the risk is that if they don't take a hard line on it, then inflation expectations can get out of hand, and then it becomes even harder to bring inflation down over the medium to longer term.
Okay, great. Coming back to the banking sector, Peter just asked a question saying, is NAB overreaction this morning, or the impairment is going to be the focus for Banking Australia? What can we expect from ANZ? Similar issue tomorrow?
Look, I don't really have anything to add about the banks, other than the fact that, you know, it's a sector that we're underweight. I know the research team have got a hold on it. I just think you just don't need to be rushing in there to buy. And that, you know, we're not out of the woods yet with that whole downward correction move. You know, whilst the RBA are raising rates and the fight is on to bring inflation down, you know, the Australian banks have got headwinds. So, yeah, like them over the medium to longer term, but I just wouldn't be rushing to buy them today, and I wouldn't be reacting to some of these sell-offs.
Okay, great. Thanks, Angus. And look, last question I'll just take is regarding oil. So Rod said oil has been on a bearish run for over 10 years. How low will it go in our opinion?
Well, the short answer to that is I don't know. Just I don't know. You know, in our 2023 predictions, I had oil touching $60 on recessionary concerns, you know, on the arrival of a global recession. So I think that's still valid. Could oil overshoot and get into the 50s? Yep, it could. Could it pull up short of $60? Yes, it could. So again, you know, a little bit like the Australian banks, you know, the energy sector hit this big period of outperformance, and I think that's unwinding at the moment. Certainly in the United States, we're seeing a lot of switching out of the energy stocks into tech. I wouldn't be jumping on that bandwagon either. And I do like the energy sector. Let me be perfectly clear about this. I really like the energy sector, and I think, you know, over the medium to longer term, it's going to be a great place to be. But because the world needs energy, and energy demand is only going to go up. And, you know, we've seen supply side constraints, underinvestment, and all the rest of it. But, you know, between now and when the oil price bottoms, you know, we could see lower levels yet in the energy sector, and some of those energy stocks could get even cheaper.
Yeah, absolutely.
So I just don't think today's the right day to be buying them. And, you know, the time to buy them is when it becomes really obvious to the rest of the world. The world is in a recession, the US is in a recession, and, you know, we stop seeing the oil price react on the downside. So, yeah, I think it's probably, the oil price has probably got a bit further to go on the downside before we see a final low.
Excellent. Great answer, Angus. Thank you for your clarity and for your insights today. I think every week we learn something new in these webinars. We have discussions on many topics which are moving our markets and, of course, moving our portfolios at the end of the day. So members, look, thank you for your company today. I appreciate it. If you're getting some good information to help you make decisions in your own portfolios, please do always provide feedback. You can email us, members@fatprofits.com.au. And I will catch you again next week on Thursday along with Angus. My name's Roger. Thanks for your company. And I'll pass it on to you, Angus, for your final words.
Thanks, Roger. Thanks for everyone listening today. And we look forward to joining you same time next week on the webinar. Have a good weekend and bye for now.